Hi there and welcome to the Maqro Minutes for this week, the 16th of April. As per usual, we'll start with a disclosure statement. The information summarised in this presentation doesn't constitute financial advice or any other professional advice and is very general in nature. It does not take into account your specific circumstances and should not be acted on without full understanding of your current situation and future financial goals. Right, so to kick it off, as per usual, stocks in our universe. We've got APE, Worleys and 3PL. So we'll start with APE. It was a current recommendation for the investing department until yesterday, where we hit price target at $15.80. It has fallen away a little bit from that price again today, down about 3%. But last week, the ABS released data on vehicle sales for the month of March. Australian new motor vehicle sales increased by 22% year on year. So they were accelerating in February, up 5%, and then continuing the sector's improvement trajectory. So about the fifth month of positive growth in a row. Dealer order book growth continues to outpace new vehicle deliveries. This strengthens the thesis on the industry's growth and APE's outlook. So it's, as I said, it was up at 1580 yesterday. That was the price target hit. We'd probably look to maybe reconsider that position again somewhere in the around the $14 range in the event of a pullback. Next up, we've got Worleys. So on the 8th of April, it was awarded a contract to provide general engineering services for Phillips 66 company to convert its San Francisco refinery in California into a renewable fuels manufacturing facility. So the project's going to produce about 2.5 billion litres per annum of renewable transportation fuels. This is all going to be from cooking oils, fats, greases and vegetable oils. It really continues to strengthen Worley's renewables portfolio, and which is very much in line with their strategy. They're up about 2% today, heading back towards that $11 mark. Next up, we've got 3PL. So it's a current small cap division recommendation, provides technology-based education platform. 12th of April, it confirmed its merger with Blake eLearning, forming EdTech education technology platform called MergeCo. The merger will expand the current product suite and diversify its channel mix. Synergy is expected to be in the range of $7.5 to $12.5 million. Combined entity will generate revenue around the 100 million mark. That's about an 80% increase from 3PL's current revenue. Merger is also expected to be 280% EPS accretive. So very good news there for 3PL. The meeting and the shareholder votes are expected to be in mid-May. The transaction will almost certainly go through. It's expected to be complete by around about the end of May once they get that through. Now, moving on to stocks to watch out for. So this week's focus is on US earnings season. We're going to cover Netflix, Johnson & Johnson and IBM. So firstly, we'll start off with Netflix. And given this is outside of our general long Australian stocks, there's a little bit more substance to this. So I'll just start with they're expected to report on the 20th of April. And it was 2020 was a numbers game for Netflix. Really strong growth in subscribers, about 31.5% over the previous period. This is basically due to travel and work restrictions and basically, people staying at home more. They were willing to pay up for streaming services and for at-home entertainment. So for instance, if you invested in Netflix at the start of 2020, you basically would have had that investment grow by about 65% by the end of 2020. In addition to the pandemic surge, they did have stronger growth in subscriber additions and came from additional international markets. So the domestic growth was nearly flat, realistically. So it's good to see them going into other markets. Now, although still following two straight quarters of larger than expected pandemic-related growth, they are expected to slow down this year in 2021, which is sort of evidenced by the slowdown in the latter half of last year. This is obviously just due to restrictions easing globally and the ongoing vaccination rollouts providing a sense of security for people to get back outdoors and go to restaurants and leisure parks and travel, etc. So Another thing that's contributing to their subscriber slowdown is their high saturation in the market. So there has been a few competitors come into the market there, like Disney Plus. I think Discovery's also into the race now as well. Analysts expect their revenue to be still around 7.13 billion, which is about a 7.5% growth over the last quarter of 2020. EBITDA nearly doubles to 1.92 billion, and earnings per share more than double at 2.99 as opposed to 1.19 in their last quarter. So despite their slowing growth, the company retains a very good economic moat. With most of their digital infrastructure, blossoming film division enables them to localise their content through local production, and backed by insights from consumer data, which they can later optimise by bringing things to a global audience, and that sort of leverages their scale. This protects Netflix market share in a market where demand for SVOD platform is dictated by quality and quantity of content. Although lacking the legacy intellectual property possessed by Disney or Warner, Netflix has made moves to shore up some of its vulnerabilities there by, for instance, signing a deal with Sony Pictures Entertainment, which starts in 2022, who decided to bow out of the streaming competition. That gives Netflix its first exclusive look into a pay TV window for Sony's theatrical releases. In a deal includes superhero blockbusters that Sony owns. I think the DC universe is sort of in that Sony production. So going forward, the company announces it's considering share buybacks to fuel growth, using its strong cash flow instead of debt. 2020, Netflix saw its revenues grow much faster, 24%, than its operating costs, which was only 16%, and that resulted in obviously net income margins nearly doubling over the period, which is a really impressive rise in profitability. As it pays a much bigger expense for actually producing their own content, which is a fixed cost. Next up, we've got Johnson & Johnson. It's expected to report on the 20th of April. Johnson & Johnson marginally outperformed 2020 versus 2019 in the pharmaceuticals and consumer healthcare. However, saw their medical devices sales drop about 50% from their 2019 figures, primarily due to the COVID impact on elective surgery and sales of medical devices. Despite this fall in earnings and increased investment in R&D, the company still managed to pay $10.5 billion in dividends, with the current annual dividend yield of about 2.6%. Management provides 2021 sales guidance where they expect to see high growth rate in medical devices, with the 2021 recovery, stabilisation of unemployment levels, medical procedures largely permissible now, given their vaccine rollout there in the US, as COVID-19 restrictions ease, followed by just a general stabilisation in their market for the rest of the year, relative obviously to the period of last year, which was, as we all know, quite a disaster. So consumer health will be negative as consumption levels return to typical usage patterns for the rest of the year. Pharmaceuticals to remain tempered over the year, with slight increases as clinics and medical offices visitors return, as restrictions ease. Analysts expect a slight decline in revenues, however, EBITDA and EPS to be up about 30 to 36 and 25% respectively, to 8 billion. The Janssen vaccine, which is pretty similar to the AstraZeneca, has come under recent scrutiny due to its cases of fatal blood clots occurring in people under the age of 50, particularly those on the contraceptive pill. US officials have urged to pause on the use of the vaccine, so delay their rollout in Europe pending their own assessment. Despite these struggles for elective surgeries, they've got some drug approvals in the pipeline as well, so that should all fuel further growth. They invest in R&D and target some robotic-assisted surgery with 3 robotics platforms in the pipeline as well. So they've got some good things going on there in the pipeline. Now, moving on to IBM. So IBM is the day before these other two guys. It's on the 19th of April. They'll report their earnings. Their revenue declined 4%, reflecting broader uncertainty in the macro environment. However, the pandemic really induced an urgency for digital transformation. So that really bodes well for IBM. Their cloud-related revenue is up 20% in 2020, which represents a third of their total revenue. Much of this growth came from modernising client applications with AI. A clear indication of value in their hybrid cloud and AI business segment is reflected by operating gross profit margin, which ballooned by 130 basis points to 49%. They also paid $5.8 billion in dividends, higher than the previous period. They've got strong cash flow, continuing to fuel growth, and they've also had recently acquired a fellow Red Hat, which is a IaaS provider. It was about $34 billion acquisition, which is going to contribute to their earnings going forward. Now, looking ahead, we have FOMC minutes and just general economic data. Just something to note as well, though, we had the cryptocurrency exchange Coinbase float last night as well. This was a direct listing, so it didn't go through the IPO stage. So there was a reference price of $250 per share. It traded on the open at about $381, which was up 52%, 53%. It eventually coming down to only be up about 35% on the day, but this represents a market cap of about $85 billion. That high opening price is probably to be expected, given the nature of the IPO being the first chance to get on board the Coinbase juggernaut, as it seems. It's really piggybacking that that recent strength in crypto and Bitcoin particularly. It trades near a record high. Bitcoin at 62,500. Fairly solid business. Very high margin. 43 million users. 7,000 institutions. And they also announced the day before that their quarterly revenue forecast for the most recent quarter was 1.8 billion, which is actually 500 million more than their previous entire year. So they've got some fairly positive things about the company, about their platform, is that you're insured against hacks, etc. So probably expect fairly big things out of that company over the next months and towards the end of the year. So now on to the economic data and releases. Next Wednesday we've got retail sales in Australia for the month of March. Similar to the US, retail sales basically they indicate the economic activity and indicate potential for inflation in Australia. Retail sales has been relatively strong. You can see that from companies like JB Hi-Fi, Harvey Norman, Nick Scali, etc. We might start to see that cool a little bit as people are allowed to travel again now, and their expenditures might be going into other areas. It's not a massive market mover, but obviously one to keep an eye on. Today we had Australian unemployment numbers as well. They came out better than expected, at up 70,000, and the unemployment rate dropped to 5.6%. They were expecting up 35,000. So really that just completely shoots apart the fears of any form of massive slowdown from JobKeeper. The ANZ job ads and SEEK job ads numbers have been extraordinarily strong. NAB Business Survey this week as well was the highest reading since 2010. So look, we don't expect any economic slowdown anytime soon here in Australia. So those numbers are a fair bit more important, I'd say, than retail sales necessarily. Next Thursday at 10:30 p.m, ECB President and Vice President will host a press conference 45 minutes after they release their monetary policy statement. Basically, there'll be a Q&A there. It'll give some indication as to the Eurozone economic health. I don't think anything is going to come out of that we don't already know. Central bankers are very well versed in keeping to the script. So it'll be more of the same, inflation transitory, expect to come out as the vaccine rolls out, et cetera, et cetera. So we, as we've seen with the Fed speakers and particularly Fed Chairman Powell, they are very good at sticking to the script, and realistically, you would not expect them to change any of their language anytime soon. And in the 25 years I've been watching central banks, they've always been very disciplined on that sort of stuff. So we won't expect too much out of that, I wouldn't have thought. Also, 10:30 on Thursday, they'll have their unemployment claims figures. These have been a little bit volatile and haven't really been a great leading indicator into the US employment numbers. It is a bit of a lagging indicator, but look, they do notice, they do have a bit of a look at those in trying to pick the payrolls numbers, even though they haven't been particularly good at picking the payrolls numbers of late. But look, I think it's the same as Australia. They're very much seeing a shortage in being able to get staff for hospitality, travel and leisure, and the healthcare sector. So that really does even more so than maybe even CPI. Labour shortages are going to be a real concern in terms of potentially increasing inflation, because wage inflation really is where central banks will look first to see if there's going to be any forward inflation. So we did have CPI numbers this week in the US. They were fairly benign. They were slightly higher than expected, but we haven't seen that push up in manufacturers and producers in inflation numbers really filter through to the consumer level as yet. So that will probably start to happen over the coming months. So that pretty much wraps things up. Thank you for attending the Maqro Minutes, and we will chat again next week.